started. Good afternoon. I'm Grant Swartzwelder, president of OTA Environmental Solutions. We're the host of Oilfield Strong, which is what you're looking at now. We reside on YouTube. If you go onto YouTube and look under OTA compression, is all the videos of previous presenters, and we'll also include Jim later today or tomorrow if you have someone that wants to re-listen or listen for the first time. Do appreciate everyone's attendance. Our next event will be July 6th, always the first Wednesday. It'll be Garrett Golding, who is with the Federal Reserve. So it'll be a kind of a different take, kind of more of a macroeconomic type of perspective, which will be interesting to hear next month. Very happy to have Jim Wicklund here. He was actually one of the very first presenters, panelists, when we started this about 2.5 years ago. And that either tells you about the program or about him that he's willing to come back and do this again.
That you'll have me back. You'll have me back.
Delighted to have you back. When you hear the local radio station talk about hot sports opinions, they're talking about their sports opinions, but they're really talking about Jim Wicklund and his views on the industry. And that's what makes him interesting and a fabulous panelist. We're going to go through, kind of start off with kind of a current state, and then work our way down through oilfield service and, of course, some ESG stuff. But if you do have questions, don't hesitate to, in your screen, you can go and look at the chat and kind of let us know, and we'll ask that question. But with that, Jim, well, and I guess the final part of your introduction, that was actually a very poor introduction, but you've been head of research for Rauscher for Bank of America, managing director there, managing director, senior banker at Stevens, and
I've been around the block. I've been around the block. That's all.
Yeah, and I think most important of all is you've actually been in the field doing oil and gas stuff.
Yeah.
And so that gives a lot of credibility in my mind. It's not just from the kind of the 10,000 feet.
It makes it harder for management to lie to me. That's what it's proved to do over the years.
Well, and you know how this thing really works from the ground up. And so I appreciate that significantly. So with that, I'm going to throw this. I know you need a softball, so I'll throw that. Tell me what in the hell is going on with this industry right now, and kind of give me an idea of, I'm seeing some drilling activity going up, but obviously there's some drivers that are keeping it in check.
It's nirvana. I mean, this is the best of all possible worlds. I mean, oil's 117 today. The rig count's 720 or so, which is higher than most people thought it would have been, 6 months, 12 months ago. Natural gas prices, $7, $8, touching $9. Economic break even in the Haynesville is $1.50. I mean, so everybody's making money. Service companies, if they're not making money today, as soon as the contracts they have start, they'll be making money. And so prices are going up. The E&P companies are seeing 20 to 30% inflation from the service companies, but oil prices have gone up so much that they're still ahead of the game, so that's okay. The service sector has supply chain problems. Everybody's got a different supply chain and a different problem, but when everybody's got the same problem, and our industry is really known for fixing problems, and so there's still some issues, but we're blowing and going. And whether you're working in the Middle East or you're working in the US, or if you've worked in Canada for a while, it hasn't been that fabulous. But you just had the Canadian government promise LNG to Europe in 3 years. And so the faded promise of 10, 12 years ago, when we were going to drill like crazy for gas in Canada with 3 LNG facilities on the West Coast, maybe we weren't wrong. We were just early. And so every place you look, drilling activity is going up. It's not going through the roof. And that's kind of your point. Yes, it's being held back because this time we don't want to lose a bunch of money. Okay. Now I can get the rig count to 1,000 and oil production to 13 million barrels a day. And as an industry, we'll probably only lose about $200 billion doing that. But the guys who own the companies go, well, I don't want to lose $200 billion. How about if I don't do that? And they're going, okay, well, that's real easy. Then we're going to start giving you a big dividend back. So you'll be happy to be here. We're going to drill enough so that we can keep our production flat to slightly up. We can turn off and turn on the budgets on a dime. So if oil prices slow down or drop, we'll slam on the brakes. And they're still only spending, the public companies at least, about 70% of cash flow. Now, 70% of cash flow at $117 is a lot more than 70% at 65. But there's still, it's a commitment of longer than tomorrow. And if you look at the future strip, oil's not $117 in 2 years. And so the New York Times actually put the nail in the coffin on it the other day on the front page of the paper. They were talking about how the oil industry hasn't responded and rig count hasn't gone crazy. And what are these people doing? And then it came down to, well, it's because managements aren't paid to grow production anymore. And if you're not paid to grow production, then you're more than likely not going to really focus on growing production. And so even the New York Times recognized the fact that the driving forces in these companies, this is compensation. And if I pay you to eat lettuce for a month, if I pay you enough, you'll eat lettuce for a month, right? Okay. So if your compensation is tied to growing financial returns rather than production growth, that's what you'll do. Now, the private companies are still growing, as fast as they can because they want to try and get bailed out. And that's a lot of capital, and the service industry likes to see that, but it's not a huge amount of the total production. And so that's what's, they're still going crazy, but they've been going crazy for a year and a half. And so you see the rig count inching up, but it's not going nuts. We have no obligation. We subsidize the global oil and gasoline price for 10 years by losing tens of hundreds of billions of dollars in net income and market value to subsidize the price of oil. That's why we had cheap oil for 10 years, gasoline for 10 years. Okay. We're not doing that anymore. And so is the 117 an overshoot? Yes. China hadn't come back from the shutdown yet. What happens when that demand starts to pick back up? I'm not that worried about Russia because, as we've seen from previous embargoes, if they produce the oil, it's going to end up somewhere. Okay. So that's just shaking out supply chains, and there'll be a couple of dollar disruption charge in there. But that doesn't worry me as much. OPEC doesn't have any spare capacity. And so I think it's going to be a shortage of supply. But I'm back to the US doesn't have an obligation to lose money to fix that problem. And so we're not going to. And if we don't lose money by doing this, that means we make money for several years, which would be a very novel situation, very positive, and be very attractive to shareholders who haven't bought energy stocks. We've underperformed the S&P for the last 7 years before this year because people didn't trust to act rationally when prices moved up. If we act rationally this time with oil at 117, knowing it could go to 150, and that would be a terrible thing to happen. And if it does, we're going back to 80. So we would love to see this be rational. And if the managements are rational, then we won't overreact. And this will be a great business for the next several years.
And in the past, it's been OPEC, OPEC plus, Saudi that's been able to open the spigot and really dictate the price. And so you're
well for a while there, but in 18 and 19 and 20, it was the U.S. The U.S. set records 2 years in a row for the fastest production growth by any company in one country in 1 year ever in the oil business. So that's when we became the swing producer, when we increased oil production by more than 1 million barrels in 2 sequential years.
But we're not.
But that's what I'm saying. That cost us billions. Yeah. And the Saudis don't want to sell oil that loses them money, so they don't.
But now what you're saying, if I boil all that in, we're not still the swing producer.
No.
Saudi should be, but they can't be because they don't have the supply.
Correct.
So who is the swing? Who's the one that's
well, Russia, because of the political aspects, okay. But right now there is no swing producer, and if there's no swing producer, that means there's no slack in the system, which is why people are saying oil could go to 150. If I had some place to go that still had slack in the system, somebody who could be the swing producer with some, political, financial, whatever incentive, we don't have that. So that's why the near-term extremes on oil price are more likely and more scary.
So then if I picked up on your point about the drilling activity, should I assume that it's going to stay the same or maybe slightly go up, but it's not going to, there's not going to be a big run up. It's just going to.
Correct. If you would have seen if you were going to see a big run up, you would have seen it start by now. And we're still so short people that, the stories coming out all the time that I could put a rig to work. I've got a contract, but I can't find a crew. Those are real stories.
Do you think it's capital, people, sand, casing, or something?
Well,
casing, I know a lot of those affect that. A lot of those affect, but what do you think is, what's the biggest? I'd love
to have a whole, find me a warehouse full of casing right now. Yeah. That would be, like Guar 15 years ago. But we'll fix that. Sand we'll fix even sooner, because we have proven we have lots of sand. We just have to put the equipment in place to mine. Okay. The guys who produce it the cheapest will always make the most amount of money, but there's no shortage of sand. And so what were my other two choices?
Capital and people.
And see, I don't think capital is an issue, because if you're not outspending cash flow, what do you need capital for? Okay. If I go, well, I don't have access to the capital markets, what do you need access to the capital markets for? If you're an E&P company, you're only spending 70% of cash flow. You're giving 15% back to shareholders in terms of dividends and buybacks. Everybody's got a variable dividend these days, and you're paying off debt with the other 15%. Now, by the end of 23, everybody's going to be debt free. Okay. So then they have to make the decision: is it still 70-30? Is it 85? Whatever the split is. Okay. But that's the making money part. And that's, that's where it's all going to end up focusing. And so I think that's the most critical part. I really do. It's not sand. It's not going to be pipe. It's not going to be capital, because I don't need any. Okay.
People.
It's going to be people. Yeah. And we had a story of one crew working the night shift in East Texas on a rig, and somebody came along and offered them 50 cents more an hour and took the entire crew, walked off the job. Now, that's stunning in that you do it for 50 cents, but the fact that you're going out and trying to steal crews at night speaks volumes as well. So I don't think capital is an issue. The Wilkes family took ProFrac public 2 weeks ago, $288 million. That's the first oil service IPO in probably 4 years.
Below target though, which is,
yeah, but that's so we're the last 5 done at the end of last cycle. So that doesn't mean much. That means your investment bankers either bullshitted you or the market changed. It can be lots of things. But investors put in money. It's the first time investors were willing to do. You do an IPO, you can sell it. This is the first time you've been able to sell an IPO to Wall Street in 4 years in service. And so depending on how the stock acts, and if there are any Atlas Sand there's a rumor out that they're contemplating an IPO. If these start getting done, but the problem is if I start coming to you and going, okay, Grant, oil's at 117. Here, take a bunch of money from me and make me a fortune. That's really expensive money. I mean, to say nothing of the actual cost of the equity, but it's the people who come and offer us money when oil's at the top of the cycle. it never works out well for them or us. Where were you when oil was 42 kind of thing, you know?
Right.
And so I am hoping we don't fall for the temptation of easy, cheap capital. So I think people still the biggest issue.
Kind of just like your rig story there, but I'll mention we went out to try to buy another truck, service truck. And our Ford dealer that we bought numerous trucks through said they are not taking new orders till July of 2023 because they've got all the orders they need and they can't get any trucks. So not only do you not going to have people, they're not going to have a truck to get to the location on. So, and that's kind of scary because what effect is that going to have when all these trucks, for example, break down and you can't get any? It's going
to accelerate the adoption of remote monitoring of compressors and pump jacks. That's what it's going to do.
Oh,
it's going to do the same automation that McDonald's kiosks did in Seattle when they raised the minimum wage to $15. You have trouble getting people or you can't afford them, so you go to automation. If I can't get enough trucks, I'll put remote monitoring on all my wells and I don't need so many trucks. So those are the kind of things that to me are driving the transition opportunities in our business. And so while it's an inconvenience today, instead of solving it the way we always would have, well, let's try and get more trucks, okay? Different ways of looking at things, that's where the opportunity is going to come in over the next several years.
One of the things that's happened over the last several years or hasn't happened is that there's usually in a bust, a number of service companies, number of companies in general go away. And that really hasn't happened. And so like, for example, we bid on a package and there were 9 of us bidding on it. That's not sustainable. How's this shake out? Because $100 oil, they're not going to voluntarily quit. They're probably getting enough cash to survive. So it's just going to keep on keeping on.
You know, bankruptcy is supposed to be, you know, what hell is to religion. Okay. It's something to be avoided at all costs, because if you go bankrupt, you go away. Well, that hasn't happened in the last several years. I can think of 2 oil company CEOs that went bankrupt who lost their jobs. It turns out that most companies, when they're going into bankruptcy, if the CEO will stay, they will give him a bonus and a raise. Okay. And it's because the funds that owned the debt don't know anything about the company. And so whether this guy drove it onto the rocks, I'll keep an eye on him this time, or not, they keep them. And they get to keep all of their assets and don't have to sell a thing. And the only thing that happens is when they come out of bankruptcy, they now have a whole lot less debt and are more competitive. Their assets have been written down so they can generate a higher ROIC than you can at the same price. You hadn't written down all your assets this year. And it does nothing but increase competition, and usually bad competition. I'm not saying all the companies that go bankrupt are bad, but some of them are, and they get to keep operating, or it's not that they're bad, but now they're bad for everyone else because they can, like I say, on a return-based world where I'm not worried that much about growth, but returns, I can charge 10% less than you and make a higher return because I've had everything I own, all my assets in the field written down through bankruptcy. This is nirvana. But that's the problem. It doesn't clean up the industry at all.
And we're not there's nothing that's going to clean it up. So we'll continue to be oversaturated and
eventually equipment wears out. Equipment that goes of a company that goes into or through bankruptcy usually isn't the best maintained equipment. And so it's definitely got a shorter field life than assets that are owned by a healthy company that's providing ongoing maintenance. But you're talking about assets, rigs last 20 years, you know, frac pumps last 6. You're talking about stuff with a pretty good tail on it. So yes, that's an issue.
What A&D or M&A market? You know, we just saw Colgate merge with Centennial. whether that's as a way to go public or get larger, largest provider or Delaware producer.
All the above.
Yeah, you're seeing different, in theory, Concho is going to be selling and Oxy has sold some. But if you don't have the capital to go in and buy that, talk to me about how you see the M&A market, A&D market in the upstream.
Well, as Warren Buffett demonstrated, there's still investors willing to invest in big oil company transactions. Okay. I'm not going to give you any money to go explore. Okay. But I'll give you money to go buy properties that work at $70 oil and a PV 10. Okay. And Shell sold its stuff at a bargain level price because it was told sell your stuff, right? So like anything in real estate, it depends on the motivation, but there's going to be that money available for the large E&P companies. That everybody looked at Double Eagle and all the rest of these. And so the privates are trying to get as big as they can, as fast as they can, to be the most attractive target, as was Double Eagle. In that consolidation, if you're the 43rd biggest player in the Permian, you're not going to get asked out on Saturday night nearly as much as if you're the 6th. Everybody's trying to be, in the top ranks. So I think consolidation in the E&P business will continue. It's too irresistible. If I buy you and you have your legal department send me all your titles to all your properties. Now fire all your people and close your offices. I don't need anything anymore. Okay. The consolidation savings of 2 E&P companies operating in the same basin can be 85, 90%, whereas you can't do that in service. Okay. Because if one pressure company buys another pressure pumping company, but it's based more on crew level expenses and activity as opposed to central, which it is in an oil company. And so I think that E&P A&D will continue. I do think there's going to be capital available for that. A lot of these things are going to be at interesting prices, because while I would love to sell my properties at $170 WTI, that's not what anybody's going to pay me. And then we have to get into an argument on what the strip is or should be. And so it's going to be some interesting price arguments going on. The service industry is a little more difficult. A lot of the private companies are looking to consolidate or get bought by the small public companies, though frankly all oil field service companies now are small. Multiples we're hearing are 3 to 4, sometimes 5, but 3 to 4 times EBITDA. It's not going to be in a big way. You're not going to see Halliburton, Schlumberger, Baker Hughes, or Weatherford, or NOV make any killer acquisitions, in my humble opinion. There are some other combinations of midstreams that would work. There's just a lot of obstacles. And right now, everybody's business is so good. I want to wait a year from now, because then my numbers will be fantastic, and then I'll sell, which is never how it works.
And that goes to, you're either going to sell or you're going to just keep producing and monetize that cash flow stream. And obviously that's in the private equity space. That's what a lot of folks have done, where they just say, you're set up to just be a cash machine and distribute. And
you can do that in public companies now too.
Yeah.
Become a dividend play and you're loved. I mean, go back to the beginning of the year, Homer and Payne was yielding 7%. Now it's only
Diamondback, Pioneer, aren't they all 7 to 10%?
Yes. What's interesting about Pioneer and Devon and several others is theirs is a variable dividend. It's not a special dividend, which they can decide to pay or not, and how much it can be. They can decide how big. It isn't a regular dividend, because this is a hyper-cyclical business, and regular dividends can bite you on the tail end in a down market. So they're variable dividends based on calculations of excess cash flow. So the question was asked by the CEO of Devon at a conference here a month or so ago, at $100 oil, what's your yield? And he said 18.4. The same question was asked by the head of Pioneer, and while he didn't answer, later an analyst published that they estimated it would be around 14%. Now, we're not going to have $100 oil forever. I don't know if we're going to have it for another week or two, three. But if you wanted to express your opinion on duration of high oil prices as opposed to the level of oil prices, you would do that through buying stocks for the variable dividend as opposed to buying stocks for appreciation. You buy low and sell high. And no matter how you look at it, if I show a chart of the last 6 years and the next 6 years of the future strip, the highest day on that chart is today.
Makes you nervous to buy at that price.
It does and should.
We got a few minutes here. So you brought up a point earlier about technology and the kind of the evolution or the matriculation of the industry with its use of technology. Kind of dovetail that with ESG, because that's also driving a lot of the changes in how they're doing their business. But what's your thoughts on that as to how, I know you believe, I've heard you say that ESG is here to stay, and I think most people have now come to realize that, but that's clearly going to have an effect on how folks manage their assets and manage their operations. And some of that, I think, dovetails into the technology, continuous monitoring, things like that.
Well, and as usual, things are being driven by several different directions. The SEC has their climate change rules pending.
Yes.
The final hearings are June 17th, I believe.
Right.
And they estimate that the annual cost of compliance with the SEC's climate reporting requirements for a small company is $490,000. And for a large company, it's $930,000. It's $930,000. And so those are big numbers, whether you're small or large. And that doesn't include the implementation upfront costs. That's the continuing cost. And so if you're going to spend that much money and be forced to by the SEC, if you're a public company, you're going to get something out of that, damn it, right? If it's going to be a cost, somebody's going to be in charge of minimizing that cost. And how you minimize that cost is through ultra ESG compliance. I'm going to turn the data we collect and turn it into we're the greenest people alive, and I'll get brownie points for that. And I'll get brownie points for that, and it'll expand my multiple. And so you're right. There's no question it's here to stay. It got a bloody nose in the last couple of weeks. Okay, when ideology hit practicality. Where BlackRock and a couple of these big money management firms actually let their individual investors vote as to whether they wanted to vote for the climate bill or for higher returns. And it turns out a lot of them preferred higher returns than voting for a cleaner environment with their money in the company they were invested in.
Who's that, BlackRock or Blackstone?
BlackRock. And so they also got told by the state of Texas, if you don't invest in oil and gas, you're not going to manage any of our state money, which right now they manage $24 billion of. And so they came out a week and a half ago and said, while we still believe in ESG and climate and all the initiatives that are being voted for here in public company annual meeting period, which is what we've been going through, we're not planning on voting for all of the climate change bills in all of the meetings, because we think we're trying to balance our commitment with shareholder returns. And so all of a sudden, you've got the biggest money out there going, okay, we still care about ESG and climate and all that stuff, and especially if they have really good returns. And so this is what it was going to end up being all along. Is you can be really, really ESG compliant, but if you don't make any money, who cares? Okay. But if you are a high profit, high margin, good business that's ESG compliant, you're rich and good looking. And in the competitive world of today, you really, really need to be both.
And here's your chance for a hot sports opinion, because I look out there and I look at like continuous monitoring, I look at drones, I look at satellite, And I wonder, is that really going to help them lower their emissions, or is that just fantastic PR?
Well, it's a combination of both. First of all, they're going to be required to monitor it. Okay. Excuse me, required to report it.
Sure.
Okay. So if you have to report it, then you have to put something in place to monitor it, right?
Right.
And so that's going to be, they're going to be forced to. Now, so the question is, do they take the easiest, cheapest route? You know, I got a satellite that looks down at my stuff, you know, once a quarter, and maybe you can get away with that. And then there are other companies who go, okay, I want full-time monitoring so that I know the day there's a methane leak and I know exactly where it is, and I can dispatch a truck out to fix whatever the problem is. Okay. And the reality is it's going to be somewhere between those two. But as we discussed earlier, if we can't get trucks, if I've got something constantly monitoring my tank battery, my well site, my compression, my compressor station, and it tells me if there are leaks, if there's methane leaks, if there's oil leaks, if a belt's not running, if the well's not flowing, and I don't have to send out a workman unless there's something to fix, as opposed to driving to every location to see if anything's broken. That is just irresistible to large oil companies. HS&E costs, lower head counts, fewer trucks and fewer emissions. I mean, I get gold stars across my forehead for stuff like that.
Mm-hmm. It's I guess the challenge with that becomes that the shells can do that. The smaller companies are more, they don't have the capital for all that.
I understand there are
So,
incredibly cheap solutions. I've seen them. I was stunned. And there are some, you know, one guy says, I've got a really cheap camera. It's only $25,000. And the other guy says, I got a really good camera. It's only $180,000. And so the price range of these things are anywhere from $1,000 a month to $30,000 a month. And I understand what you're saying, but even the small companies can afford the de minimis, but the small companies are typically private. And so it's a little bit motivation. But, you know, if you don't care, you know, if you're a private oil company and you flare gas and your next door neighbor thinks you're a jerk, so what? So the smaller the company, the less it's going to matter. But the bigger companies, the public companies, the private equity backed companies, Jim Bob Exploration or oil may not care, but the private equity backed companies all have to care. So a lot of the industry is going to have to care.
So you do all that, you get this data, but the oil industry typically is perceived as not being that forthcoming or people not trustworthy. And so you try to send that message out to the world and it hits a wall.
Well, yeah, but now you're talking about a completely different issue. And that is the industry has done such a bad job of education and PR over the last 25 years that that's an issue every day in every way, having nothing to do with just this. Agree completely with your point. There is nothing we can do that will really stop us from getting vilified. But there was an interesting point made by a guy who's in Austin who was on one of my panels recently. And they're an advocate for the oil industry. And he pushes, we shouldn't be apologetic for this at all. But he said that every company needs to have in their newsletter, instead of an explanation as to why we're important, list 4 things that have a lot of hydrocarbon product in them that are humorous and interesting, so that your truck driver at the next kids softball game on Saturday morning can go, did you know that cell phone has 4,700 pieces made from oil and gas? And approach it from that way. We have always tried to preach our story in the Wall Street Journal. It needs to be on the back page of the National Enquirer in large font.
Well, and you also wonder why all these independents or companies don't put $1 million of advertising out. It's
be wasted money.
It would be wasted.
I think so. I mean, the trade associations, it's really up to them to have done this. If you remember the chemical industry, now you think of the chemical industry, a little bunny hopping across a green field. They did a great job. Exxon stopped the API from doing that for 20 years. And so we are behind the curve, but all the trade associations are working in concert now to fix that. But it takes time. And like I say, we're 20 years behind the chemical industry.
Fair enough. All right, Jim, we try to shoot it for 30 minutes. We have 36 minutes, so we went over just a little bit. You have any final thought? And if not,
no, sir. Thank you for the time. Thank you for the opportunity.
As always, thoroughly enjoy it. Best of luck to you, man. Thanks. Thanks, everyone.